Start. Hello, welcome everyone. This is our wonderful workshop, Retirement for Creatives, led by Dr. Elaine Grogan Luttrull. My name is Sapira Chirk. I am with the Nevada Arts Council. I am the Artist Service Specialist. Thank you, Elaine, so much for being with us today. I'm going to go ahead and do a quick intro for Elaine, and then Elaine, you can take it away. All right, Dr. Elaine Grogan Luttrull, CPA, PFS, AFC, is the founder of Minerva Financial Arts, a company devoted to building financial literacy and empowerment in creative individuals and organizations. Her workshop and presentation has been featured nationally by groups that support the arts, including Creative Capital, the Pew Center for Arts and Heritage, and the Joan Mitchell Foundation. Sundance, Firelight Media, and the National Young Arts Foundation, and a variety of state art councils and commissions. Elaine spent 10 years in academia, teaching at the Columbus College of Art and Design and serving as the department head for business and entrepreneurship from 2014 to 2018. She regularly provides guest lectures for colleges, universities, and conservation that serve the arts, including the Juilliard School, the New England Conservatory, the School of Visual Arts, and the Cleveland Institute of Art. Before that, Elaine served as the Director of Financial Analysis for the Juilliard School and in the Transaction Advisory Service practice Ernst & Young in New York. Elaine is the author of Arts and Numbers, and she has contributed regularly to industry guides, including Professional Artist Magazine, Business of Art from the Center of Cultural Innovation, and Create a Living Legacy from the Joan Mitchell Foundation. In addition to degrees in accounting, Elaine completed a doctorate in instructional design leadership, enabling her to build, deliver, and assess the impact of educational offerings. She is based in Dublin, Ohio, Kaskaskia, and Hopewell Indigenous and Cultural Lands, where she serves on the board of the Short North Alliance. Welcome, Elaine.
Thank you so much, Sophia. What a pleasure to be joining you and bringing some of this information on retirement strategies and some secrets to the creative individuals all across Nevada. It's really such a pleasure to be here today. So thank you for having me. I'm going to share my screen so we can dive into the content. I welcome anyone to take screenshots and notes as we are going through all of this, and a copy of this presentation will be provided along with the recording. So feel free to use these materials in whatever way would suit you best. Hopefully, you are a creative individual who has some self-employment income. It's totally fine if you don't, but if you are someone who does, our goal is to review the retirement options you have that might go beyond what you might have from a more traditional employer. Because if you are self-employed, there are still some really interesting ways you can save for retirement. There are some challenges that come with that as well, but there hopefully are some things you can take away as you secure your financial future. More specifically, during our time together, I'm going to go through the types of plans that are available to self-employed individuals, plus a couple that are available to anyone that has any type of earned income. We'll estimate the total amount you might want to think about saving per year, including any amount that might be sort of capped out by different plans. We'll go through some terms, some technical terms like elective deferral and things like that. And then I will invite you to list your own action steps as you think about maybe what you might want to contribute for 2024 for your retirement funds, and then also thinking into the future. So we have a lot to go through. Some of it will be very technical, some of it will be a little more holistic, but I hope you find something useful there. As Sapira said, I'm Elaine. It is such a pleasure to be with you. I am by far the luckiest money person ever because all I get to do is hang out with creative individuals and help with the business and financial side of their creativity. Even though I am a CPA, I am not giving you tax, legal, accounting, or investing advice as part of this conversation. So we want to make sure it's just for educational purposes only because there's a lot of nuance to this, but I do hope it will still be helpful for you. And where I'd like to start is with this question that sometimes comes up with creative folks who might never want to retire or never stop making creative work. And for what it's worth, I hope you never stop contributing your creativity to the world. And I'd encourage you to save some money anyway, just in case. And the just in case part is really just about your long-term financial security. Right now, you're probably bringing in some money and having some expenses to fund your life. And in a perfect world, there's going to be a little bit of extra, a positive net income or a profit in your business. That little bit of extra becomes some of your savings. And as your savings and your net worth grows over time, the dream is we can use some of those savings to provide income for you in the future, right? So instead of always having to earn new income, especially in later phases of your life, we want to use some of your assets or some of your savings to provide that future income. That doesn't mean you can't still earn money in the future. You absolutely can, and many of you will, and that's fantastic. But this will give us a little bit of a cushion so that you don't have to continue earning if some of that new income can come from your assets. Basically, what we're doing is leaning into this idea of flexibility. I would love for you to be able to choose when and how much you would like to work or teach or perform or write or lecture or do any of those other sort of creative jobs that contribute to your overall creative career. That might include working less or it might not, but I want you to have the flexibility to make that choice when the time is right. Which then brings us to maybe the first of our math questions, which is how much should you be saving? If I've convinced you that saving is a good thing, the next logical question is, okay, how much should I save? And when we think about this in the context of kind of your overall financial picture, what I'm mostly thinking about is saving for the long term. So for 10 plus years into the future, maybe even longer than that for some of you, but that's a little bit different than saving for kind of a short-term emergency or something that might happen in the near term. We want to keep a long-term focus here. And so a very quick benchmark to be aware of is the general guidance to aim to save between 10 and 15% of what you earn. If you are looking just for a very quick calculation about what you quote unquote should save this year, this is a good option for you, between 10 and 15% of what you earn. Here's what it might look like. This is someone who is able to save $5,000 toward long-term savings. They're hitting an overall 12% savings goal, which is pretty fantastic. They're also spending $8,000 on their business, setting aside about $12,000 for taxes, and spending $24,000 on personal costs. Your numbers might look wildly different from that, and that's okay. I just wanted to give you a moment to sort of illustrate what this could look like. I will also say all savings is good savings, and some people find 10 to 12 to 15% to be an ambitious savings goal, particularly given all the other financial challenges we face. So all savings is good savings. 10 to 15% is not a terrible benchmark if you're looking for one. But sometimes folks say, well, should I save for this or should I save for that? Or should I pay down debt or should I save? What should I do, right? Which of these should I prioritize? And here I would invite you to take a lesson from our friends in the improv community and see if you can make progress toward each of those goals, right? We don't have to make all or nothing type of decisions or choices, right? So it is totally fine to save a little bit for the short term and a little bit for the long term if that's a position you are in right now, right? I might prioritize the short term first just for that emergency safety net, but I also hate for you to miss out on some of the long-term time gains of starting your retirement fund early. So yes, and is an okay approach to take. If you're looking for another good benchmark to think about maybe what you should save for retirement, one option is to think about replacing 80% of your current income in retirement. This is a rough calculation that gained popularity among some financial planners, and the math can be a little fuzzy, but it's an interesting way to think about in that later phase, maybe let's think about replacing 80% of your income. So in this example, this person is currently bringing in about $50,000 worth of income. Very roughly, using simplified math, we would say, okay, if they wanted to replace that, they would need about $1 million in a retirement account to replace that amount. What I did here is basically assume that there would be a 4% distribution rate from this pot of future money, meaning we would spend 4% of the total every year in retirement. That would generate $40,000, which is about 80% of their current earnings. Very quick and dirty calculation, but if you're just looking for a number to like hang on to, thinking about replacing 80% of your income is not a terrible strategy. But there is an opportunity to go a little bit deeper. This is very, very simplified math. And there's a worksheet that we've shared as part of this program that invites you to play around with some slightly more specific numbers in case you wanted to get a little bit more detailed on this. This is our first example here. This person spends about $50,000 a year currently, and they'd like to basically replace this in retirement. So the question is, how much do they need to save to do that? You can play around with this by saving this worksheet to your own Google Drive, and you can put your own desired retirement spending right in here. I've put $50,000 in here, and then you can see this gives us a range of maybe what we might need in retirement that ranges from $40,000 to $60,000. You can play with these numbers as well, depending on how aggressive you want to be with some of these percentages. But then we say, okay, if I know I'm going to need, say, $50,000 in retirement, I'm going to have some additional sources of income. One source might be from a Social Security distribution. If you haven't checked your Social Security estimate, you can create an account on myssa.gov. That's not a terrible action step to take if you want to get a sense of where your work credits are and what your Social Security distribution might be. I have this modeled out at basically $1,000, $2,000, and $3,000 a month in Social Security benefits, but you can put in your own numbers as well. And then there's also a spot here for you to think about additional income you might have in retirement, maybe additional sales you will have, or performances, or royalties from various projects you've done. Again, you can play with these numbers. I've set this to 0 at the low end of the range and $10,000 at the high end of the range. But really, this is customizable so that you can play around with what might work for you. Then this calculation plugs in the difference between what you will have in these various scenarios and what you would need to have distributed from your retirement savings. We've also assumed you will pay about 20% in taxes on this. That is a very rough assumption. Your rate might be substantially lower in retirement or substantially higher if your income is quite a bit higher than what we've modeled. But for purposes of this, we basically say you're going to pay some taxes, you're going to have some Social Security, and you may have additional earnings. So what size retirement pot do you need to fund all of that? And you can see, based on that 4% distribution rate, we get to $837,500 as our total retirement goal. Remember, in the simplified version, we just said $1 million. That was a 4% distribution rate. This takes into account some investment gains over time and some other assumptions. So it basically gets you a slightly more accurate and maybe slightly more achievable goal of $837,500. But then you might say, okay, Elaine, that sounds really nice. How am I going to save $837,500? Because it feels like a huge number. At this point, once you know your ish number, we can move to this annual additions tab of the worksheet. And in this annual additions tab, our first example is based on the same person. Let's say this person wants to save $837,500 in their retirement. They have already saved $85,000 in this model. And the question is, how much more do they need to add or save each year to get to their goal in 20 years? And all of those are different variables we can play with. So the specific direct answer is that this person needs to add $9,644 to their retirement account each year over the next 20 years to grow it from 85,000 to 837,500. That seems a little insane until you start looking at the details of how the investment gains really start to add up over time. In fact, by year 4 in this model, the gains are more than what you are adding each year. So that means your money is earning more than you are putting in annually, which is where a lot of that growth is coming from. Now, we have assumed there will be 8% annual growth. That's a pretty standard assumption. If you wanted this to be a little bit more conservative, you could assume a 6% growth rate, which means you would need to aim for a larger contribution in the years. Or if you wanted to be a little bit more aggressive in your modeling, you could play with a 10% annual growth rate, which means you would need to add less every year. You can see this changing over time, which means as you are going through this, you can update it for whatever happens in real life so that you can play around and adjust your numbers accordingly. The other number you can play with is the number of years you have until retirement. The longer you have, the less you have to save in each of those years because you can take advantage of a lot of that growth. If you have a very short period of time until retirement, you will need to be a little bit more aggressive in the amounts you are putting in. But you can see if someone has, say, 25 years instead of 20, then they need to contribute less per year to reach that same goal. Or if they only have 10 years and they need some pretty substantial growth, they're going to have a pretty high annual contribution goal. So these are basically the variables you can play with to figure out how much you might want to save to reach your long-term goals over time based on a whole lot of characteristics that are unique to you. There's another example here I'd love to draw your attention to. Example 2 here, this person wants to reach that $1 million mark and they have already saved $375,000. The question is, how much more do they need to add to reach their goal in 15 years? And you can see the annual addition for this person based on these assumptions is 0. As it is with their $375,000, if it continues to be invested and earn about 8% annually, they will have more than $1 million in the next 15 years or so. So again, this doesn't mean you can just forget about everything. We want to pay attention to what those investment returns look like and maybe update the model when we know different things. But it's pretty nice to run the numbers and say, you know what, I'm in good shape, especially if you have been diligently contributing to retirement and been able to save a substantial amount here. So those are the first 2 tabs of the worksheet. The future value tab, where we estimate maybe what that total retirement balance might be, and then the annual additions tab, where we say, okay, based on that future balance, how much do we need to add each year to get there? A third option, as you're thinking about what your retirement goals might be or what your savings goals might be, would be to look a little bit more specifically at your real numbers. And this is especially relevant for anyone who's getting closer to that next phase of their life. I might say if retirement is maybe within the next 10 years or so, this is not a terrible option for you to take because you have more clear information about what that next phase might look like. So in this example, instead of using current spending or sort of current earnings and setting aside a percentage, this approach basically says, what do I want my retirement to look like and what is it going to cost? And for this person, it's going to cost $78,000 or so to retire in the way they want to retire. So if they know they want to spend $78,000 a year, Again, roughly, we can back into an amount of almost $2 million that they might want to spend from retirement. We can also play around with the calculator on this future value tab again and see what that might look like. So if I were to go to this blank side where I can put in my own information, I might say, I'd like to spend $78,000 in retirement. This will model a couple of different options. I could think about what Social Security or any annual earnings I might have might be. Or if I think there won't be any, okay, I can just say I need enough of a distribution to fund $78,000 a year. So that's going to be my $1.95 million number. So again, lots of options here to play around with what might make sense for you. The 3 ways to kind of think about how much you could or should save. Option 1, budget on what your retirement is going to look like. Most relevant for anyone who's relatively close to retirement. Or you could just roughly aim to replace 80% of your current expenses in retirement. Or you could aim to save between 10 and 15% of what you're currently earning. These are all great starting points to sort of inform your own savings goals. So that brings us to our first action step. I might invite you to jot down a rough estimate of your total retirement goal, maybe using the future value tab of the worksheet, if that's helpful. And then write down a rough estimate of what you personally would like to save for retirement in 2024. And maybe think about what you'd like to save for retirement in 2025 as well. Having those numbers tangibly in front of you can be a great motivator. At this point, it might be interesting to share some additional things that sometimes come up for folks. These are maybe additional or other savings tips, and they all sort of relate to staying flexible. In the arts, we know your income probably fluctuates, sometimes very dramatically over time. And that means your retirement contributions might fluctuate as well. So in all the modeling we do, we assume you will be able to put $9,466 into your retirement each year. But in reality, that may or may not work for you based on what your earnings look like. You might have a really fantastic year, and then you might have some slower years. So it's okay to let these retirement contributions fluctuate with your income. If you find yourself in a particularly good year, especially with some windfall income, you might want to lean into some additional contributions. And you might want to think about accumulating these savings during the year, but waiting until the end of the year to make those retirement contributions, again, because of so much uncertainty. That works really well for a lot of creative folks. There are also creative folks who say, no, Elaine, if I have the money, I'm going to spend it. So I need to put it in my retirement account right away. That is also perfectly fine. You know yourself best, but it's okay to lean into some flexibility based on what happens for you individually. I would also remind you that your needs may change over time. So if you are working on this and putting some numbers together and you are in your 20s or 30s or 40s, that is fantastic. But don't forget to continue to check in with some of these plans because lots of things may change. You might end up needing to spend less in retirement if you have, for example, purchased a home and fully paid it off, so you no longer have that monthly expense. Or you might find yourself in a situation where you need a bit more expenses to cover long-term care or other medical needs as you age. That is also perfectly fine. But again, those things are really hard to anticipate years in advance. So don't forget to check back in with these plans as your life unfolds. It's also worth noting that one of the reasons this is becoming a more important conversation is that individuals are living longer. So if you find yourself retiring or entering a different phase of your career when you're 65 and you live to be 105, that is 40 years of existence that you will need to fund with some sort of accumulated assets, right? So we're looking at a much longer period of time here than maybe our grandparents may have thought of. So it's important, again, to stay flexible and to recognize that this might be a larger amount than you might otherwise consider. So with all of that and the embrace of flexibility, I want to move us into another more technical conversation where we talk about some of the different retirement plans and the different limits to contributions for those plans, because there are limits to what you can save for retirement, even though there's no limit to what you can save. There are limits to what you can contribute to retirement accounts annually. And the first limit is called an elective salary deferral. So this means someone is basically deferring income from this year into retirement, right? That means they're taking some of their income and putting it into a retirement account. They are deferring to use it until the future. The maximum amount an individual can electively defer in 2024 is $23,000. In 2025, the number goes up a little bit to $23,500, but your elective deferral limit in 2024 is $23,000. I should say your elective deferral is also limited by your earned income, right? So if you are earning less than $23,000, you will not be able to defer more than you are earning. But $23,000 is the amount to keep in mind as your elective deferral. However, if you are over the age of 50, you have what we call a catch-up contribution that gets added to your elective deferral. So in 2024, instead of being able to defer $23,000, you can defer $23,000 plus this additional $7,500 catch-up amount. So that means if you are over the age of 50, your elective deferral amount for 2024 is $30,500, which again is nice if you are an artist who maybe didn't have the opportunity to contribute to retirement earlier in your career. If you are now at a point over age 50 where you're earning some additional income, that could be a really nice moment to lean into some of these catch-up contribution limits so that you can increase your annual contribution. But there's a special extra new rule for 2025 as well. This was part of the Secure 2.5 Act that was passed in 2022. And since we are right on the cusp of 2025, I wanted to make sure this was on your radar. This does not impact 2024 at all. But if you're starting to think about what you might save for retirement in 2025, and if you are turning 60, 61, 62, or 63 years old in 2025, you have the opportunity for something they're calling a super catch-up. I hope they rename it before this really, really takes off. But you have basically an extra $11,250. Instead of having the normal $7,500 catch-up contribution, your catch-up contribution, the super catch-up, is actually $11,250. This is only for folks who are turning 60, 61, 62, or 63 in 2025. And as it's written, it's only going to last for 2025. So if that fits you and you are in a position to save more for retirement, take advantage of this super catch-up. If you're over the age of 50, but not one of those ages, you still get your $7,500 catch-up. So I told you we were getting a little nuanced and technical here. Elective salary deferrals, $23,000 in 2024, nudges up to $30,500 if you were over the age of 50. And in 2025, it nudges up even further if you are one of those special ages between 60 and 63. But beyond the individual elective deferral limit, different types of retirement accounts or retirement plans have limits on what you can put into those plans each year, right? So a couple of different ways to slice these different contributions. One limit, the one you might be most familiar with, is the IRA contribution limit. For a traditional or Roth individual retirement account, an IRA, individuals are allowed to contribute $7,000 in 2024. If you are over the age of 50, your limit is $8,000. In 2025, these limits will remain unchanged. There's something called a simple plan. The limit for what you can contribute to a simple plan is $16,000 in 2024. And you also may have heard of a SEP IRA or a solo 401k. The limits for contributions to those accounts are what we call 25% of plan compensation. And I'll show you how to calculate that in a moment. So there's the elective deferral limit, what you individually can defer from your income until a future year. There are different limits that come into play for different types of retirement plans. And there's something called an annual addition limit. So from all sources, including maybe your contributions and maybe a business or employer contribution to all different types of plans, the annual addition limit someone has is $69,000 for 2024. If you are over age 50, that is increased by that catch-up contribution limit. So you have a little bit more room to play there. But when we talk about maxing out your retirement, it's important to understand that some people might have access to enough plans to be able to contribute the annual addition limit. But more realistically, individuals will run into these plan-based limits and possibly the elective salary deferral limits that will limit their contributions. So they will max out at a number that is under 69,000. So what we have to play with is basically which pocket is the money coming from to be added to the retirement account. There's an individual pocket, and then there's a business or employer pocket. What type of plan do we have, and how much can we maximize that? And using those multiple pockets and the different types of plans, how close can we get to this overall annual addition limit, assuming your goal is to maximize retirement, right? That's sort of the puzzle we're trying to save or trying to solve together. Which means we need to know more about each of those types of plans so that we can dig into the option that's going to be the best for you. So when we think about how you should go about saving for retirement, you basically have three options. If you are employed by someone else, and if that employer offers a retirement plan, that is option one. You can save through your employer. Or maybe depending on your situation, you can save through your own savings as long as you have earned income. Or if you are running a business, you have some opportunity to open up a separate account through your business to save for retirement. So those are basically your three options: through your employer, through yourself as an individual, and through your business. And I want to start with the employer plans, because if you are employed by a company that offers a plan, this plan is established by your employer and it allows you to make pre-tax contributions to your retirement from each paycheck. You basically sign up for it and then allow them to withdraw some money from each paycheck. And instead of paying you, they put it into your retirement account. Employer-sponsored plans, right? If you have access to this, especially if your employer has any sort of matching money offer, you will want to participate in this plan. They are helping to underwrite the fees of the plan, so it's less expensive for you. It is tied to a paycheck, so there is very little for you to do or for you to decide, right? The money is automatically transferred. And if there is free money, meaning your employer will match your contribution if you contribute a specific amount or up to a specific amount, you should take full advantage of that. I don't think it is revolutionary financial advice to say if there is access to free money, you should take the free money. That's essentially what matching is if your employer offers it. This is probably administered through your HR or payroll provider. There's probably a lot of paperwork for you to review. And If this is something you're participating in, it might be worth thinking about nudging up that contribution rate over time, especially if you regularly get raises from your employer. That's a good time to nudge up the contribution rate as well, because you might not notice it. In general, you have to have earned income to participate in these types of plans. The money is pre-tax, meaning it reduces your taxable income when you're making these types of contributions, unless you choose to make Roth contributions. That is typically the exception rather than the rule. Most folks contribute pre-tax dollars to these types of plans. The dollars grow tax-free until you take them out in retirement. And in general, the dollars vest right away, which means they are yours. So if you leave your job, you can generally take those retirement dollars with you. Now, you probably don't want to take a distribution from them. You would probably want to roll them into a new account that is in your name, but it is essentially your money and it is portable. It doesn't stay behind with the employer if you leave the job, if it vests immediately. After you leave the job, generally you cannot make contributions to that same account, but again, you can move the money into your own retirement account. We call that a rollover, and then you can make additional contributions to the new account. So that's the employer plan option. If you have it, take full advantage. If you're thinking about saving for yourself as an individual, we have something called an individual retirement account, an IRA. A traditional IRA is an account that you can open on your own without having an employer, and it allows you to contribute an amount and then get a tax deduction for that contribution. We call this pre-tax because you are not being taxed on those dollars. You get a deduction for them. As I mentioned, the limit for contributions to a traditional IRA is $7,000 in 2024, and there is a tax deduction you can claim, which is fantastic. It's worth noting that some of the deductions might be limited, but for most individuals, they get a tax deduction for these contributions. The money grows tax-free over time. So that means if you invest $7,000 in an IRA tomorrow, and there is some sort of massive stock market rally and your money doubles within a week or two, you do not have to pay tax on that gain, right? All of that is tax deferred. The balance can just grow tax-free until retirement, which is lovely. But it is taxed when you take it out in retirement. Why? Because you didn't pay taxes on it to begin with, so you have to pay taxes on it when you take the money out. That's basically how a traditional IRA works. The deduction shows up on Schedule 1 of your tax form. It's called IRA deduction, and that's where you would see your contribution when you file your taxes. Again, generally, you have to have earned income to make this contribution. You get the tax deduction and the dollars grow tax-free. The really nice thing about an IRA as well is that you have some timing flexibility. You have until tax day, basically, to make a contribution to a traditional IRA and have it count for 2024. So if you are someone whose income is not necessarily predictable, it's really nice to have a little bit of extra flexibility on the timing of that contribution. Traditional IRA is going to be a great choice if you really value that tax deduction. So if your income is on the higher side and tax deductions start to feel really good for you, a traditional IRA might feel really nice, and you don't mind setting aside the funds for retirement. Another option for an IRA is called a Roth IRA. And a Roth IRA is very similar to a traditional IRA in that both are individual retirement accounts that you can open up as long as you have earned income. The big difference is when you pay the taxes. For a Roth contribution, these are post-tax dollars you are putting into the Roth IRA, which means you do not get a tax deduction for the contribution. So you still have the same limit, $7,000. And that, by the way, is for all IRAs. Again, it's $8,000 if you are over the age of 50. There is no tax deduction. So you are paying taxes on the dollars in the year you're earning them. You still have tax deferred growth of the account. So the dollars are invested and they grow and you do not pay taxes on any gains. And then when you take the money out in retirement, you have already paid taxes on your contributions, so you can take that money out tax-free in retirement, which is really nice. Again, the difference between traditional and Roth is when you are paying the taxes. Now for a Roth or later for a traditional. It has the same timing flexibility as a traditional IRA, which is also really nice, particularly if your income is flexible. And as we start thinking about some of that timing flexibility, you can start to play around with multiple year contributions as well. So in this particular example, a creative entrepreneur receives a totally unrestricted $15,000 grant, maybe in January or February of 2025. They could open a Roth IRA for 2024 and make a $7,000 contribution using that unrestricted money. And they can make another $7,000 contribution for 2025. And they can do all of this in January of 2025, essentially putting all of their or most of their unrestricted award or grant into their retirement account. Now, whether they want to do that or not is a different conversation, right? It depends on their goals and their flexibility and all sorts of other things, right? But because you have some of that timing flexibility, you can play around with that when you might get a windfall like that. You'll notice there is no deduction for a Roth IRA. Why? Because those are post-tax dollars, right? So unlike with a traditional IRA, you do not get a tax deduction for those contributions. And a Roth might make sense if you are in a relatively low tax bracket. You might prefer to pay taxes on a relatively low amount because you might prefer to pay at a lower tax rate. You also have a little bit more flexibility to access the principal of a Roth IRA before you retire without paying a penalty. I don't love doing that. I think if you put money in for retirement, you should pretend you can never ever touch it again, no matter what. But there is a bit more flexibility with a Roth. And it's worth noting that both of these options are good for different reasons. And many people end up having both traditional IRA dollars saved and Roth IRA dollars saved. And that can help with your future retirement tax planning. So if you have access to an employer's plan, you should take advantage of it. If you have earned income and you're in a position to save up to $7,000, a traditional or Roth IRA is a really, really good option. Your third option for saving for retirement is through your own company, your own self-employed kind of options as a creative entrepreneur. And there are three different plans I want to draw your attention to: the SEP, the Simple, and the Solo 401k. So for a SEP, a simplified employee pension, this is a written plan and it allows business owners to make contributions to their own or their employees' retirements, right? It is a contribution that is only coming from the business, right? Which is why it kind of makes sense if you think about a pension, right? That we think about that coming from the business as opposed to an individual contributing from their income, right? So a SEP is funded strictly from the business. And remember, if you are self-employed as a sole proprietor or a single member LLC or any other entity type, you are a business. So you are eligible to create this. Make sure you're following all the tax laws, and then start contributing from your business to your retirement. Because this is a business contribution, you can still make an individual contribution to a different account, right? So this is a business contribution. It does not affect your elective deferral. So you can still contribute to, for example, a traditional or a Roth IRA, in addition to having a SEP contribution through your business. The timing on this is also really flexible. You do have to have a written plan governing your SEP, but you have some flexibility to set this up and make contributions anytime before tax day, which again gives you some flexibility if you have a really, really good 2024. The overall contribution limit is, of course, limited to that annual addition number, but it is also limited to 25% of plan compensation, which is a special calculation that gets unnecessarily complicated and circular. Basically, we look at the income from your trade or business minus all of your business deductions, and then we deduct half of your self-employment tax and whatever contribution you're going to make, and then we take 25% of that. But there's a slightly easier way to calculate it. Here's our example. This person earns $56,500 from lots of different things they did during 2024, and then they had $14,000 in business deductions. That means their net earnings from business are $42,500. We reduce this by half of their self-employment tax, $3,251, and then that gives us their adjusted compensation amount. Instead of taking the contribution as a subtraction from that and multiplying that by 25%, there's a math shortcut where we can take this adjusted compensation number, 39,249, multiply it by 20% instead of 25%, and that gets us a very close approximation of what you can contribute as a business to the SEP for 2024. For this particular person, it is $7,850. That's their SEP business contribution. And they can still make an IRA contribution of $7,000, which means they're now at $14,850 saved for retirement, which, as you can see, is definitely more than they could contribute if they were only doing an IRA. So the purpose of having something like a SEP would be to open up some additional avenues for contributions so you could get closer and closer to that maximum amount. Your business income, of course, shows up on Schedule C, and then your contribution to your SEP shows up on Schedule 1. It gets deducted in Part 2 of Schedule 1 on line 16 here. That's where that deduction shows up. Again, it's a little bit of a complicated calculation, but it can be a really nice option for you. The next type of plan you could have if you are self-employed is called a SIMPLE. It stands for Savings Incentive Match Plan for Employees. Much like a SEP, a SIMPLE has to be a written plan, and it enables individuals to make contributions, and then the employer, that's you, has to match a portion of those contributions, right? So this works a little bit more like a 401k or a traditional retirement plan in that there's an individual contribution and also a business matching portion, whereas a SEP is only a business plan. A SIMPLE has to be for a small employer, so fewer than 100 employees. That is generally true for most of the artists I'm working with. And then individuals elect to make contributions as well. The business then matches a percentage of those contributions. The big drawback for a SIMPLE is timing. It has to be set up before October 1st, and then any individual contributions have to be made before December 31st. The business match can happen after the end of the year, all the way up until tax day or the tax filing deadline. But administratively, you need to set up and start making those individual contributions earlier with a SIMPLE. And that tends to be the big drawback because often it is around this time of year that people are exploring their retirement options. And if SIMPLE is what you would like, you'll have to wait until 2025 unless you have already set it up. For a SIMPLE, individuals can contribute up to $16,000. That's the 2024 limit. And this does count toward their overall elective deferral limit. So if you max this out, you can contribute $16,000 yourself to your SIMPLE. And then your business can match up to 3% of your compensation. So if we look at our same hypothetical example person, their net earnings from their business is $42,500. They can decide to put the maximum amount into their simple, that's $16,000, right? And then the business makes their contribution of 3% of adjusted net earnings, right? So again, that subtracts that half of self-employment tax. That contribution is $1,177. So that part comes from the business. The $16,000 comes from the individual. If the individual has more to save, they could also put money into an IRA to max out that elective deferral amount. But you can see we're nudging upwards above the elective deferral by adding this business matching portion to it, right? Which again, can be really appealing. The simple contribution also shows up in the same part on Schedule 1 of your tax form, which is nice. You can see exactly where it's going. So first option is a SEP, only a business contribution. Second option is a simple, an individual contribution with a business match. Third option is a solo 401k. This is the plan that will generally give you the highest possible contribution to your retirement. So if you are looking to absolutely max out your retirement, solo 401k is probably going to be the way that gets you there. This is a qualified plan, and it allows you to make your own elective deferral to the plan, and then also to add a business portion. Your elective deferral, you can make any amount up to that $23,000 amount. And then the business contribution is going to be the same calculation that the business can use for the SEP, right? So if you're keeping track at home, right, that SEP contribution is higher than the simple contribution of 3% of compensation, right? So the solo 401k will get you that larger business contribution, and individuals can max out their elective deferral as well. You don't have quite as much timing flexibility on a solo 401k. It does have to be set up by the end of the calendar year, and you have to make your individual elective deferral contribution by the end of the year as well. But the business contribution, that 25% of your adjusted earnings, can happen anytime before tax day. So again, as we're thinking about nudging up those numbers, 23,000 is a much higher amount than you could contribute to an IRA, plus you get that same SEP contribution. So here's what it looks like in math or following our example. Got the same person, right? 42,500 is their net earnings. They can elect to contribute the full elective deferral amount to their retirement account. Now, of course, that's not available for them to live on, so that's a different conversation. But if they're in a position to save a lot of money, $23,000 is a ton of money to be able to save for retirement. And we multiply 20% by that adjusted compensation number and get that $7,850 number here. So this will give you your largest possible savings or additions to retirement following this solo 401k approach. Here are basically the different plans and the calculations presented on one page. In our example, the person has the same net earnings minus half of their self-employment tax. And then we basically just look at, okay, how much is the business contributing? How much is the individual contributing? Can they also do an IRA? You can under a SEP or a simple. In this example for the solo 401k, the person has already maxed out their elective deferral, so they cannot put any more into an IRA. But if they don't max out their elective deferral, then they could. And then you can see if our goal is to maximize our retirement contributions, solo 401k is going to get the highest possible contribution. SEP is nothing to sneeze at, though. Being able to contribute $14,850 to retirement is absolutely incredible, right? So I don't mean to minimize it, but if your goal is to absolutely maximize your contribution, solo 401k is going to be the best way to get you there. I have this all in a separate worksheet. only because it is very, very complicated and there's a lot going on here. So this is this third tab within the worksheet I shared. In this one, this basically models the different contributions under different plans. We have our example person here with their earnings and their ordinary and necessary business deductions. This is changeable based on whether they are under or over 50 years of age, and that will automatically update these limits here. And then you can see how we're basically saying, okay, if this person only does an IRA, they can save $7,000, and that's amazing. If they do a SEP, they could get to $14,850, counting the IRA and that business contribution. If they do a simple, they could have $7,000 to an IRA, $16,000 of their own money to the simple, and $1,177 from the business going into the simple. Or if they do a solo 401k, they get that maximum amount there with the elective deferral and the business contribution. You can see here as well, I've estimated what the typical fees are to manage these types of plans. Your IRA is super low, sometimes even negligible. SEP IRA does have some fees. Solo 401k does have high annual fees. So, that's something to think about as well. If you are in a position to save up to $7,000, contribute to an IRA. We don't have to overcomplicate anything. But if you are in a position to save more than that, you might want to think about adding a SEP or maybe even a solo 401k so that you can increase that contribution amount. I will note as well that this is modeled for folks who are sole proprietors or single member LLCs. If you are an S corporation, the same plans are still available, but instead of adjusted business earnings compensation numbers, what we do is we look at the compensation you are paying yourself through your S corporation. So it's that number that drives the contribution limit. So just make sure if you're a sole proprietor, you're using the right tab here in the worksheet. As we think about all of these things, right? Every single plan requires some sort of like formalization of it, the SEP, the simple, and the solo 401k. A financial institution can set this up for you. That could be your bank or your credit union, maybe. If you already have investment accounts somewhere, you also might want to explore what it would look like to open one of these accounts at any of those brokerage platforms, because many of them can do it as well. There are going to be fees, and don't forget about those setup and contribution deadlines, because it does take some time to do the paperwork. But if we sort of set aside a lot of the complications, right? If you have access to an employer-sponsored plan, go ahead and take full advantage. They're helping you underwrite the fees, and there's an ease to participating in their plan. If you're able to save up to about $7,000, hang out with an IRA, either traditional or Roth, depending on your tax preferences, and then contribute as much as you are able, and that is fantastic. If you're in a position to save more than that, I would probably layer on some sort of plan through your business. And then lastly, if you are one of the fortunate folks who is in a position to take advantage of those catch-up contributions, either the regular ones or the super ones in 2025, it's not a bad idea to take advantage of them. So with that, I will invite you to your second action step, which is to choose the option that makes the most sense for you in 2024, and maybe thinking about what makes sense in 2025 as well. Is it going to be an IRA? Is it opening a solo 401k, right? What's going to make the most sense for you? And then think about how that option compares to the target amount you wanted to save each year in that first action step. Because again, depending on kind of your savings goals and how much you want to save for retirement, different plans or different combinations of plans might get you there. That is the end of our prepared content. We went through the different types of plans that are available. We estimated the total to save per year to reach various goals, and we went through a whole lot of very specific terms. There's also an invitation for you to dive in to complete some of your own action steps as you think about your own retirement. So with that, I will end with gratitude and then open it up for questions for anything that might have come through the Q&A or through the chat.
Yeah, I don't see any questions. And
Okay.
yeah, I think we are good. Thank you so much, Elaine. That was fantastic. That was very, very knowledgeable, and you presented the information in such a clear way for me, somebody like me who's like an artist and like numbers. What?
Yes.
So that was fantastic. Thank you so much.
I'm so, so glad. Thank you again for supporting these conversations. I hope they were helpful, and I hope the slides and the resources and examples and the worksheets serve all of the Nevada artists really, really well.
Thank you.